All right, here we are. We've made it to the final letter of Can Slim, M, from market direction. This is the big one, the one that tells you when to put the pedal to the metal and when to slam on the brakes. Let's dive in.
Think about it like this. C, A, N, S, L, and R are the high-performance engine of your race car. They're the power, the fuel, the speed. But M is your steering wheel, your brakes, and your GPS. It's what keeps you on the track and stops you from flying off a cliff when the market takes a sharp turn. It protects absolutely everything.
Oh man, I think we've all been there, right? You do all the homework, you find this amazing company. It's got great earnings, a game-changing new product, the chart looks perfect, you pull the trigger and buy it, and for a day or two you feel like a genius. Then boom, it just nosedives 5, 10, 15%, and it's not just your stock, it's everything. It is one of the most frustrating feelings ever, and it's exactly what this last letter is designed to help you avoid.
And William J. O'Neill just hits the nail on the head with this. When the really big players, we're talking the huge mutual funds and institutions, start quietly selling off their shares, it creates this invisible undertow. And even the strongest, best stocks get pulled down with it. You've got to know what the big money is doing.
Here's the best analogy I can think of. Trying to buy stocks when the overall market is falling is like trying to swim against a powerful ocean current. I mean, you could be Michael Phelps, the greatest swimmer in the world, but eventually you're going to get exhausted and the tide is going to win. The whole goal here is to figure out which way the tide is flowing and swim with it.
And get this isn't just a clever saying. O'Neill's research uncovered some pretty incredible data. A stunning 3 out of every 4 stocks will move in the exact same direction as the general market. Just think about that for a second. That means if the market's in a downtrend, you have a 75% chance that any stock you buy is also going to go down, no matter how good it seems. The odds are just overwhelmingly against you if you try to fight it.
So how in the world do we read this market tide? Well, it's not about gut feelings or watching financial news. Nope. You have to become a detective, and you have to look at the evidence every single day. And the evidence comes from these 3 vital signs: what the major indexes like the S&P 500 and the NASDAQ are doing, how they're trading, and most importantly, how much volume is behind those moves. That's where you see the footprints of the big institutions.
Okay, so let's get down to it. How do we spot trouble on the horizon? The M in Can Slim is all about learning to see the warning signs that a perfectly healthy market is starting to get sick. It's not about predicting the future. It's about being prepared for what's likely to come.
So what's the clue? What is the single biggest tell that the big money is quietly sneaking out the back door, even while all the headlines still sound great? Well, it has a very specific name and an even more specific definition.
This is it, right here, the distribution day. When a major index like the NASDAQ closes down for the day but the trading volume is higher than the day before, that is a massive red flag. Why? Because it's telling you that the big institutions are selling, and they are selling with force. Their selling is overwhelming all the buying pressure, and that's a clear sign of a market that's losing steam.
Now look, a single distribution day is just a warning shot. It's not time to panic. The real power comes from counting them. Once you spot that first one, you go on high alert. You start scanning for more of them over the next few weeks, and when you start to rack up 4, maybe 5 of these heavy selling days in a short window, the evidence is pretty overwhelming. The market has officially shifted into a downtrend, and your job is no longer to make money, it's to protect the money you've already made.
And this isn't just theory, this is real-world stuff that works. Just look at the NASDAQ right before the giant financial crisis in 2008. The market was practically screaming warnings at us. You got one distribution day here, another one a week later, then look at this, 2 back-to-back. By October 19th, you had 5 clear signals that institutions were dumping shares. Every single one was another alarm bell telling you, hey, sell your weak stocks, take some profits, and build up your cash.
Okay, so we know how to get out. That's defense. But how do we know when it's safe to get back in the water and play offense again? Well, just like there's a specific signal for a market top, there's also an all-clear signal that tells us a new bull run has probably started.
So how do we know the coast is clear? We watch for something called a follow-through day. So after a market has been falling, it'll try to rally. The first few days of a rally are usually pretty shaky. You can't trust them. But if on day 4 or 5 or 6 of that rally attempt, a major index suddenly surges upward on huge, above-average volume, that's your signal. That is the green light. It's a powerful sign the bull is back.
So, it all just boils down to this really simple framework. You have to ask yourself, is the market in a confirmed uptrend, kicked off by a follow-through day? If yes, that's a green light. Go, be aggressive,
Buy the best CanSlim stocks as they break out. Or, has the market been flashing a bunch of distribution days? That's a big red light. Stop buying, sell your laggards, and protect your portfolio by raising cash. Simple as that.
All right, I know that was a lot to take in, but it really centers on two absolutely critical concepts. So let's do a super quick quiz just to make sure these two big ideas are locked in.
Okay, first question. What are the two things you need to see on a chart to officially call it a distribution day? Think about it for a sec. The answer is, a major index has to close lower for the day and the trading volume has to be higher than the previous day. Price down, volume up.
All right, and question number 2. What do we call that powerful signal, the big green light that tells us it's time to start buying stocks again after a correction? That, of course, would be the follow-through day.
I want to leave you with this one quote because it perfectly captures the mindset you need to succeed. It really doesn't matter how much you love a company, its products, or its story. If the overall market tide is going out and your stock is going down with it, then it is a bad stock for your portfolio at that moment. Your loyalty has to be to your own capital, not to a ticker symbol.
And with that, you have it. The final piece of the CanSlim puzzle. From current earnings all the way to market direction, you now have a complete, time-tested system for navigating the stock market. Seriously, congratulations on making it through this whole series.
Now, mastering this stuff definitely takes practice, but you have a huge head start. To keep learning about this system and other powerful, statistically proven ways to approach the market, make sure you hit that subscribe button for more explainers just like this one.
And if you want to go back and review any of the letters we've talked about, or maybe you just want to binge the whole thing from start to finish, go ahead and click the link up there on your screen to go straight to the full 8-part CanSlim playlist. It's the best way to make all this information stick. Thanks so much for watching.